Right, this tutorial here is a little bit more advanced than our other ones at the moment. We was going to save this, or we intended for this to be a members only advanced tutorial because it is a little bit advanced, but we wanted to give you a sneak preview of the sort of things that we teach our members. This is the sort of tricks that people who trade for quite a while still don't actually know things like this. So it's not a well-known trading tool or technique, and that's why we want to save a lot of this sort of stuff for our members, because we don't want to be teaching stuff that everyone knows. There's quite a few aces up our sleeves at the We Make Mints team, so we want to be sharing that with our members, but this for you is a sneak preview of the sort of things that we've got. So let's crack on. We call this the free and out rule, and the reason for that, well, we'll go into it. Right, guys, if you could do us a favour and just pause this screen. There's a lot of information. Just pause it and read this information. Right, perfect. The stock market is three types of traders. The first are the very good traders that probably work for investment institutions, things like that, people with big money. During a downtrend, this is the example we're going to give. During a downtrend, what they will do is they will buy, and they will buy quite aggressively. That will actually soak up a lot of the selling and actually cause a rally in price. What happens now is group number two, the semi-smart traders, the day traders, people who trade for a living, or people who are just watching the company, whatever. They notice what's happening and they join in. They start buying as well, which pushes the price of the stock even higher. That then closes as an up day most of the time. Day number three, we've called them the slower, poorly capitalized traders. These are the ones that they aren't confident enough to buy when the price is falling. They want to see quite an obvious rally before they jump in, and these are the ones, God bless them, they buy the peak of the rally every bloody time. But this is what happens on day three, because they start buying because they're quite happy now. Oh, it's gone up for a day. Oh, it's gone up again. It looks like it's going to go up even more. That's the psychology when people first start trading. But of course, by the time they start buying, the group number two, the big boys with the big money, they're actually looking at taking their profit because they have gone against the trend. The stock's been going down and down and down. They bought big. It's gone up for a day, gone up for 2 days. Now they want to be taking their profit because they know they're not going to start an uptrend. It's still in a downtrend. So that's the reason why we call it free and out. On the third day, you do not want to be buying. But let's go on. Right, so in a situation like this, again, any tutorials that we have where we've got lots of writing, just pause and take in the information. So in the example given here, this is obviously not an actual chart, it's something that we've made. You get a downtrend, you get day one, where the big boys buy in, day two, where everyone else jumps in, and day three. In this situation, we actually have a small up day, but what you'll learn, we've got some examples coming up to show you. Day three in this situation is normally very weak. If it's not a down day, it's a very small up day. It's not a day you want to be buying on. So let's skim through and look at some other bits and pieces. So we're really driving home now. If you are looking to buy a share that's going down and down and down, you see an up day, random up day, and then a second up day, you do not want to be buying after that up day, because traders know in a downtrend, if you have a rally in a downtrend, people are going to be selling it, people are going to be taking profit and going short or whatever they're looking at doing. So the main message of this is buying on the third day is the greatest risk. It's not a good time to put your money to work, because what we've basically said is the big traders entering the market on day one, causing this rally. They're going to be taking their profits. So it's if you learn one thing from this video, it's in a bear market, do not buy the third day up. It's not a good strategy. We've got the chart here for Barclays. As we've got two examples on here. As we said, day three after a 2-day rally is typically weak. if you look at example 1, you've got one update, or one larger update, two quite a big update. The momentum from day 1 is carrying on, and more people are jumping on the bandwagon because they realise what's happening. So if you're buying on day 3, if you look at day 3, it opens, goes a little bit higher, and then that's where the profit taking comes in, the short selling, etc. Day 3 finishes down, it actually gaps down on day 4. So if you bought on day 3, you would have made quite a big loss. And this is, guys, this is such a simple rule, it's such a simple guideline to follow. But look what would have happened. I mean, this is a real example. You know, look at the second example. You have a big down day, then you have day 1 of an up day, day 2 of an update, and day 3 yet again opens, carries on going up. So if you're a bit unsure of yourself and you're thinking, oh, it's gone up twice, maybe you know, I don't know how high it's going to go, I don't want to miss out on an opportunity. It opens and it goes up, and it goes up a little bit more, and you think, oh my god, it's going to go up loads. I watched this come down and it's gone up and up and up. You buy, and then it absolutely tanks on you, finishes down on the day, and then a few days later it absolutely tanks. So this is such a simple rule, guys. Don't be buying on the 3rd day in a bear market. Again, just this is Barclays again, at a different time period. So if you can actually pause the screen again and just have a look at these examples. So the first 2 examples come in an uptrend. The trend then changes, and we're going to a downtrend. If you look, you have 2 quite big up days, followed by again weakness on the 3rd day, going downwards. We've actually got 2 examples right next to each other where you have 2 up days followed by a down day, 2 up days followed by another down day, and then the market gives you a couple of days to get out, and then you have that massive red candle. This is classic examples of where the big money is causing a rally against the trend, or a movement against the trend, but they're out by the 3rd day. So this is why the free and out rule is just so important. So you didn't think it just was exclusive to Barclays, we've pulled up a random FTSE company and decided to go with Vodafone. The first example comes in a downtrend. Day number 3 actually gives you an update, but it does show some weakness. Look at the size of the candles on day 1. Day 2, a few times actually, has been the biggest day, but on day 3, showing a little bit of weakness. That the amount of rising on the day 3 is not as much as the previous 2 days, which is a clue. Buying pressure sort of dropping, and then by day 4 on that pattern, you're starting to go in a downtrend. There's a couple of examples on here for you to just take in and have a look at. Right, just to conclude then, because I think we've taught you everything that we certainly can teach you about this. It's just a tool for your armoury, this free and out rule. It doesn't guarantee you a turnaround after day 3, but the principle makes absolute sense. It's basically going against its trend for 2 days, maybe 3 days. The chances of you getting a really big 4th day going against the trend is quite remote, because of the profit taking, etc. So it is a good strategy to sell 3 days up in a downtrend, and to buy 3 days down in an up market. And if you think about it, that one of the first things that anyone teaches you about trading is, in a bull market, when the prices are going higher, you buy the dips. 3 days down in an up market is probably as good a dip you're going to get in a lot of circumstances. And in a bear market where the trend is going downwards, you sell the rallies. So selling 3 days up in a downtrend is probably as good of a rally you're going to get most of the time. So just remember this rule next time you're thinking about buying a stock.